Hello, friends. We continue our journey of understanding the fundamentals and the technicalities of investing in a company. We covered the topics of promoter shareholding, the impact of increase in their stake, the impact of decrease in their stake. We also understood about FII and DII and what will be the impact if you try to buy a stock when the change in the FII and DII or the institutional investors change. We continue with the next part, that is about pledging of shares. Is it dangerous for the shareholder? Remember, when we take a loan, we always have to give something as a security. Similarly, if the promoters of the company want to raise funds, they can do this by pledging their shares as a collateral with the bank or NBFS. Pledging of shares is always dangerous for retail investors. It can cause a sudden crash in the stock price. Let's have a look at the various aspects of pledging. Shares are considered as an asset, and on the balance sheet it is shown on the asset side, and hence banks and NBFS consider shares as a security to raise the loan. During emergencies, shares can be pledged to raise funds. Pledging of shares is a process where the promoter keeps his holding of the company as a collateral for debt with the bank. They take loan either to satisfy their personal needs or for funding the company's growth. Pledging of shares is done as a last resort. Why? Because when the promoter does not believe that there are any other assets which he or she can pledge as a collateral, they take the last option of pledging their part of the shareholding against the loan that they want to take. During the bull market, pledging does not create any issues because the promoter can rely on the optimistic value of the stake, and the lender also don't think much because they lend only 50% of the share value as the debt. The problem begins when the market enters in the bear phase. Drop in the share price leads to the decrease in the collateral value. It means that the shares that were initially worth 100 crores will now be worth 50 crores. To protect the loan amount or limit the risk, the lender then asks for more collateral. Hence, the promoters are forced to pledge more shares. If they don't do this, the lender has the right to sell the pledged shares in the market and get the amount recovered. So, pledging can even lead to promoter losing their stake in the company. A similar situation happened when Vijay Kantilal Seth of Great Offshore. Mr. Vijay's family left the control of his business in 2009 due to the high level of pledging. He had raised 200 crores by pledging more than 99% of his stake. But there was no other aspect also. Many times promoter pledged their share to expand the business, pay off the debts, or even carry on for some acquisitions. Pledging of shares become extremely risky when it goes beyond a certain limit, and the company finds it difficult to recover from that position. Promoters who have pledged a large chunk of their shares as a debt have always seen that the company's share price have fallen down. For example, there was a company which was trading at 150 to 170 levels in 2005 and 6. It sometimes even raised to the value of 252 in May 2006. High pledging of shares had been followed by a huge crash in the share price, and the share in 10 years time reached the value of rupees 3. Debt of this company was rolling like anything. Another example is that during mid-June 2009, promoter had taken 78% of their stake, pledged it out, and 1 year after that they pledged around 91% of their stake due to the demanding situation. In 2012, the promoters had to reduce their stake to 31%, out of which 97% of their shares were kept as collateral. This is about Falcon Tires. Similarly is the case with Maharashtra Polybutane. It witnessed a downfall of 300% in its share price. It increased its pledge share to 74% in December 2011 from 25% in June 2011. and continuously had to pledge more shares at regular intervals, and then the pledge stake became 95% of their holding. There are many more examples where the high promoter pledge led to massive crash in the stock price. If the pledging of shares is so risky, then why do promoters do it? Fundraising is very difficult during adverse and macroeconomic situations. Due to the economic slowdown and increase in the cost of borrowing, however, to expand the business, one needs to raise funds. So, in this scenario, pledging of the shares has come as a convenient solution. Another thing is that when any company is given debt, they don't get further loan without the collateral. In such a scenario, the only option left is to pledge the shares. On a contrary note, a pledging is not always bad. Like we take home loan, car loan, etc., even companies can need monetary support. Similarly, in our case, we have a consistent income and we are confident that we would be able to return the borrowed amount, then there is no worry. Similarly, in the case of a fundamentally strong company, if the companies are comfortable to pledge the shares and they have no issues, they can pledge 2 to 5% of their shares and then it is fine. But whenever the shares that have been pledged goes beyond 10% of their stake, then we as shareholders should start worrying. What should investor do? Always avoid companies where the promoters are increasing their share pledging. Investors should keep a close watch on the percentage of the promoter's pledge share. An increase in the pledge share may devastate the earnings of the company, thus leaving no room for earning growth. High pledging of share is followed by high debt. So, a major part of the profit goes for paying off the lenders. It affects the retail investors by minimizing or eliminating the options of the dividends which they are expected to receive. Appreciation in the share price is also very less because of the low earning per share, the EPS, which is covered in a separate video. Pledging of shares put unnecessary risk on the stock price. Even a quality business can become a victim of such situation. The sudden crash in the stock price is quite common due to high pledging of shares. So, why you should take such a risk? It is better to avoid completely such risk. I hope you have understood why we should not buy shares of the company where the promoter has pledged their shares. We are going to have a free webinar on 8th of July at 4 p.m. Indian Standard Time. If you are interested, please register in the link that is given in the description below. If you like the video, please click on the like button. If you have not yet subscribed, please click on the subscribe button and don't forget to click on the bell icon. Thank you.